Amazon Inc., ticker symbol AMZN, is currently trading at $228.58 a share. It is down slightly, and the reason for this is they just released their fourth quarter earnings for 2024. We're going to be going through these numbers, then taking it to my automated stock valuation spreadsheet to see if Amazon is a buy or a sell using the discounted free cash flow model, comparable company model, easy for me to say, dividend discount model, and the Ben Graham formula for intrinsic value. So, just quickly looking at the share price, if we go over the last year, it's about 31%, which I believe is beating the S&P 500, which over that similar time is up about 20%. 5 years, beating the market again, 120 to 80% here. So it has had a big run up recently, and if we look at the all-time charts, it is trading at its all-time highs. So let's have a look at the earnings here. We'll just scroll down to the statements of operations. Here we have the 12 months ended 23-24 and the 3 months ended 23-24. Net product sales 76.7 to 82.2, and on the full year 255 to 272 billion. Net service sales 93 to 105, so that is up 318 to 365. Total net sales 169 to 187, and 574 to 637. So everything is up. Now, if we scroll down here, we can see the segment information, segments being North America, International, and AWS. Net sales up about 10 billion in the quarter, 105 to 115, and up 152 to 138. Net sales, international up slightly and up again, 113 to 142. And then we have AWS 24 to 28.7, 90 to 107. So this is a ever increasing part of Amazon's revenue, catching up to international, which is its next largest. So actually what we'll do now, we've had a brief look at them. We'll put in the ticker Amazon and we'll switch between the two and talk about it here. So this will load all the latest company financial data and we can have a look. If you're interested, check out my Patreon, links are in the description. So 2.5 billion market cap, PE ratio of 41, which is slightly high, well, a lot higher than the market average, which is currently 30. Earnings per share $5.53, a beta of 1.16, meaning it's more volatile than the market, and analysts do say it is a buy at $260 a share. They do not pay a dividend, so we will not be doing a dividend discount model despite what I said at the start. Here we have the revenues, and we'll look at them now. So all-time highs, ignore the trailing 12 months because we have the full year now, so this is all calculating the 2024 number. So all-time highs 637, and we saw where all of this came from. Now, net income. All-time highs again, 60 billion. Now, if we go back to the sheet here, we can see the net income there. Here we go, you have the consolidated. For the quarter, 10 billion to 20 billion. And for the prior year, it's gone from 30 to 59.2 billion. So all-time highs in the profit. And now, where was the page I was looking for? We can see those margins. We won't go through everything here. But in terms of, I'll zoom out one tick, just that's too much. We'll keep it on here. So operating margin varying between 5 and 8% for the North American segment. Operating margin on international segment, it was negative and about 3%. AWS 30 to 36%. So this is the sort of apologies there, most profitable part of their business and has their highest margin. So despite them, what we're about to see is having quite low margins, obviously the AWS is what's bringing this up and the sort of traditional e-commerce is bringing it down. So let's go back to here, free cash flow, 32.88 billion. I believe if we go back to here and scroll up to the very top, actually we'll just type in free cash flow, saves me, oh, there you go, right there, there you go, 38 billion compared with the 36 in the trailing 12 months before. So if we go back to here, you can see, yep. In fact, this might be a little bit out of date because we're looking at the operating cash flow versus CapEx. We might need to update this. But if we look at the operating cash flow, CapEx has increased massively, but operating cash flow is at all-time highs, which is why they have so much free cash flow. Shares outstanding, they have actually been issuing more shares according to this. They were historically sort of buying back shares for a period and then started issuing more, and has been some splits. But they do give out a lot of stock-based comp, for example, which is why these shares outstanding considerably increase. So let's have a look at the discounting free cash flow model. This is where valuing stocks, looking at future free cash flows and discounting them to today's value. Currently, it's giving it a price of $140 a share. Let's have a deeper look at these numbers and see if we agree. So we're expecting about 700 billion and 760 billion in revenue over the coming years. And analysts are saying we're pretty much dead on there, so that's good. Net income margins, yeah, I think this number is wrong. I think we put that at about 8%. I think their margins have increased. Let's go 9%, 9.29%, bringing us to $194 a share. Okay, so this is where we're a bit all over the place here. You can see that the net income to free cash flow is all over the place here. So I think, oops, we'll go back to here. Yeah, 135 is way too much. So realistically, it's going to be a lot lower than that. Somewhere in the region of, we'll be a bit more generous, even 70, 80%. Puts us at $115 a share. So discounted free cash flow model does not like the stock. Dividend discount model we cannot do because Amazon does not pay a dividend. Ben Graham formula for intrinsic value. Let's just, before we even continue on this, let's see what analysts are expecting for growth over the next year. 20%, which is good, but still not a buy, $127 a share. So finally, this brings me to the comparable company model. This is where valuing stocks, looking at competitors of similar sizes and industries. We're looking at the revenues, revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, and PEG. But then more specifically, EV to revenue, EV to EBITDA, PE, and forward PE. So just looking at the S&P 500 companies by weight, Amazon is number 4. So I'll look initially at Apple, Nvidia, and Microsoft, and then we'll look at more close competitors, I would say, as Nvidia are probably not the same. So we'll go AAPL, MSFT, and Nvidia. And what this will do is load up all the latest company financial data so we can compare. So if you're interested, as I said before, check my Patreon. It's the $4 tier for this. And we've got 12 members currently and growing, which I'm very happy about. But anyway, enough of the hard sell. So, enterprise value, Amazon is the smallest here. Revenue, highest revenue, obviously massive e-commerce giant, but then obviously the AWS as well. Revenue growth rate, despite this, is still the second highest, only Nvidia, and they have been going crazy the last couple of years. EBITDA, second lowest. Net income, least profitable, and smallest margins by quite a bit, 9.3%. Price to sales, it is the lowest. Price to book, it is the lowest. PEG, which is Peter Lynch's price to earnings growth. Ideally, you want this only one, and the only one under one here is Nvidia, which is pretty crazy. I don't think we could have said that a few years ago. EV to revenue, it's the lowest here by quite a bit. EV to EBITDA, lowest again. PE, second highest, and forward PE is the highest. So, interestingly enough, PE ratio doesn't like it. EV to revenue loves it. Puts it about $400 a share. So that is quite interesting. What I'll do here is I'm doing this on another screen. You can't see this. But I just want to compare and see against some other stocks. I'm just looking at sort of comparable companies and seeing what it recommends. Now, if we were to take off Nvidia, for example, and put in Goog, oops, I put that in lowercase, but it doesn't matter. Which I sort of similar in the cloud. It still puts it at a buy at 285, but the reason for this is because of the high EV to revenue numbers here. EV to EBITDA, PE, and forward PE, it is not a buy, but this is bringing it up. So what we can compare it to as well is something similar. We'll go WMT for Walmart, and we will do cost for Costco, and we'll just compare against those two specifically and see if it is a buy or a sell. Now, obviously, they don't quite have the giant AWS side of their businesses, but is similar in terms of profit margins. Obviously higher than the retailers, but lower than the big tech giants, and still not a buy. Reason for it, EV to revenue, it is a lot higher than all these, but in terms of EV to EBITDA and PE and forward PE, it is a buy compared to these. So yeah, I do like Amazon, but the models aren't really loving it. Discounted free cash flow model says it's overvalued. Ben Graham hates it. Comparable company model puts it about fairly valued. or a little bit of a buy if we compare to Nvidia as well. Right guys, thanks for watching. Please give a like on the video if you enjoyed, subscribe if you're not already, check my Patreon, and I'll catch you guys next time.